Hi, nice to be with you. Today we're going to talk about managerial accounting kind of broadly, an introduction to managerial accounting, and what we're going to be talking about in more detail this semester. So today what we want to do is just talk about the differences between managerial and financial accounting. We want to look at the classes of manufacturing costs, understand the difference between product and period costs, and then we'll real briefly look at how to compute the cost of goods manufactured and discuss some trends that are out there today. One thing I want to point out again that I mentioned in the introduction to the course is managerial accounting and cost accounting mean the same thing. When I went to school and when I was in accounting practice, a lot of times you'll hear managerial accounting called cost accounting. And when we get into the semester, I'll probably call it cost accounting as well. That's just how I was brought up and how I understand it. And it makes some sense because what managerial accounting is economic and financial information for managers and for other internal users. It is cost accounting. What we will spend the semester doing is looking at how do we allocate costs, how do we measure costs, how do we account for costs. It applies to all types of businesses. It applies to manufacturing. It can also apply to service and merchandising businesses. Historically, cost accounting was predominantly used in manufacturing, but there's been a real movement toward using managerial accounting or cost accounting in merchandising and service industries. So we're going to see that more. So what managerial accounting is really looking at that internal reporting, and you can see here that it's part of an accounting system. So whereas last semester we really focused on financial accounting, which was financial statements, quarterly and annual reports that were designed primarily for external users, what you see with managerial accounting is this is information we use as a company for decision making and for managing our operations. It's really more internal information. So you can see here on the left column there's features. In the middle column, there's financial accounting, and in the right column, there's managerial accounting. So even though it's accounting, it's all accounting, the purposes of them are pretty different. So financial accounting focuses on an external user, whether that's stockholders, creditors, regulators, and it's mainly financial statements, quarterly and annual financial statements. These statements, if you're a publicly traded company, remember, are audited by a CPA. And it's generally things that pertain to the business as a whole. It says here they're highly aggregated, right? So if you're General Electric and you have 20 subsidiaries, those subsidiaries get aggregated in the financial statements. You don't see the cost to manufacture every product in the financial statements. You see an aggregated cost of goods sold. And importantly, external external users expect your financial statements to comply with GAAP. Right? For them to be audited successfully by a CPA, they have to comply with GAAP, generally accepted accounting principles. Managerial accounting or cost accounting is designed primarily for your internal users, management, division heads, folks who are involved in the day-to-day decision making in the company, inside the company. And these internal reports happen as often as they need to. They can be pretty ad hoc. You might have scheduled reports weekly, monthly, quarterly, but you'll also probably have some ad hoc cost accounting reports that are generated as needed. They can be very specific purpose. So it can be looking at the cost to make a specific widget, right? Or the cost to make products in a specific division, rather than the general purpose of the overall financial statements. Importantly, managerial accounting reports aren't audited, right? They're designed for internal use. Some of that information wouldn't pass an audit, right? It might not be compliant with GAAP, but maybe it's information that we need to enhance our understanding of the company operations. And this information is usually more detailed, right? It might go down into the subunits of the business. It might even go down into individual products within the subunits. So I think it's safe to summarize that management accounting is, managerial accounting, cost accounting is internal. Financial accounting is external. So when we think about the functions of management, there are three main functions: planning, directing, and controlling. These aren't necessarily cut and dried. There's a lot of overlap. Planning is maximizing short-term profit and market share, or otherwise adding value to the business, right? It's probably just what you think of when you think of planning. It's looking at, it could be looking at market strategies. It could be looking at what we should bring to market, what we should offer the market, where we need to reduce costs, etc. Directing is coordinating diverse activities in human resources. This could be anything from incentivizing employees through wages and bonuses. This could be looking at all of the activities in the organization and helping to implement planned objectives. Really directing focuses on a smooth running operation, right? Getting the people you need, having the processes that you need to achieve the objectives that you need. This is sort of the day-to-day directing. And then controlling is keeping those activities on track, right? You can think of controlling more as the managerial level or the executive level. It's keeping activities on track. It's making sure that the goals we identified in the planning stages, making sure that they're achieved, making sure that they're achieved through the steps that were taken in the directing stage. And controlling, you can use an informal or formal system of evaluations. When management does performance reviews, for example, that's an example of controlling. So think of planning as sort of that strategic vision, directing as the act of doing, and then controlling as sort of the oversight management, looking at whether goals were met and achieved. So these three functions really underlie the basis of cost accounting. And as we go through the text, you'll see that planning, directing, and controlling are loosely how the topics that we discuss are divided. Organizational structure really affects planning, directing, and controlling. An org chart shows the interrelationship of activities. It shows the delegation of authority and responsibility. There's a sample org chart on here. This is a very simple org chart. You can have org charts that are 100 layers deep, right? And you can't tell who's who without printing it out on poster board. But an org chart's important because it really lets you know where the buck stops here, right? So, for example, on this one, you see the vice president of operations in the green reports to the CEO in the pink, who reports to the board of directors. And then this is a publicly traded company in this example because it ultimately, the board of directors reports to stockholders. So the org chart is important when you're understanding a company, and it ties fairly closely to the concept of planning, directing, and controlling. So that's an overview of management structure, management in 1 minute, right? And so now we're going to move in and we're going to talk just a little bit about costs. And, this week's lecture is really more of an introduction. We'll be actually focusing the rest of the term on costs. So today is really definitional. So when we look at manufacturing costs, managers need to be asking questions. There's some examples here, right? What costs are involved in making a product? What costs are involved in providing a service? If we decrease production, what's the effect going to be on our cost? What impact will automation have on our costs? Can we bring in robotics? Can we bring in assembly lines? Is that going to reduce our cost? How can we best control costs? And that last question is probably the overarching question in all of this, right? How can we best control our costs? So when we think about manufacturing, manufacturing defined is activities and processes that convert raw material into finished goods. And those activities and processes are classified into direct materials, direct labor, and manufacturing overhead. Those are the three things. Direct materials, direct labor, and manufacturing overhead are what make up manufacturing costs. So before we look at direct material and direct labor, I want to define direct and indirect costs. This isn't in your book explicitly, and I think it's important to touch on. Direct costs are related to a particular cost object, and they can be traced to it in an economically feasible way. And a cost object can be different depending on what your company is. The cost object is the thing you're making or the thing you're doing. So it's a product or a service or a customer. It's the widget, right? So direct costs are costs related to a particular cost object. they're costs that can be traced to it in an economically feasible way. If it's a dollar screw or a dollar nail and it's going to cost you $50 to track it, that's not economically feasible, right? So that's the concept of materiality, if you remember back in your financial accounting class. Some examples of direct costs: manufacturing materials, right? If you're building refrigerators, you need the steel frame, you need the refrigerator coils. Employee wages, these are employees that are in your factory making that refrigerator. And even freight, right? The freight that the folks who make the refrigerator coils, they're sending those coils to you, you're paying freight on them. Indirect costs are costs that are related to a particular cost object, but you can't trace it in an economically feasible way, right? This might be that bucket of $1 screws, I don't know. But the things that can't be traced in a feasible way. And indirect costs, instead of getting assigned to a particular cost object or a particular product, they get allocated across all the products. And some examples here: rent, utilities, office supplies, insurance. So direct ties to a product directly, indirect does not. So indirect is indirectly allocated. So when we think again about manufacturing costs, we have direct labor, direct materials, and manufacturing overhead. So raw materials are anything that you use in the manufacturing process. Not shocking. Direct materials are materials that can be physically and directly associated with the finished product during manufacturing. It's usually something that becomes a part of the product, right? So if you're building mailbox posts, wood is obviously a direct material, or maybe steel is a direct material. Indirect materials are not physically part of the finished product, or they're an insignificant part. It wouldn't be economically feasible to track it, right? So this might be those screws or, adhesive or something like that, right? And that would just get lumped into manufacturing overhead. You wouldn't try and allocate your bottle of glue. You're putting two drops of glue on every mailbox post. You're not going to try to allocate that two drops of glue to every mailbox post. It just doesn't make sense. That would get put into manufacturing overhead. So direct materials are what are important here. They're physically and directly associated with the finished product. Similarly, direct labor is the work of factory employees that can be physically and directly associated with converting raw material into finished goods, right? It's the person who's working. I guess we're making steel mailbox posts. We look at the welder here, right? It's the person who's actually working on building that mailbox post or building that refrigerator, or a factory employee who's putting a door on a car. That's direct labor. Indirect labor is work that is not physically associated with the finished product, or it's impractical to trace the cost to the good produced. So that becomes part of manufacturing overhead as well. So this might be a factory safety inspector or a factory foreman, right? He's not directly working on an individual product, but his work has an impact on the manufacturing. So it would get lumped into part of manufacturing overhead. So what is this manufacturing overhead? Well, really it's just where all the indirect costs go, right? So indirect labor goes there, indirect materials go there. They're costs used by multiple activities. They can't get assigned to a specific cost object. By default, they just get allocated to everything, right? Since direct material and direct labor is the only thing that applies to a unit of production, and that's another word for a cost object, is a unit of production. So if you're in an automobile factory, a car would be a unit of production, right? So since direct material and direct labor are usually considered to be the only costs that directly apply to a unit of production, manufacturing overhead is by default everything else, right? It's all the indirect costs of the factory. Now this doesn't include, and this is where it gets a little gray, and we'll see this through the semester, right? Manufacturing overhead doesn't include selling and administrative functions, right? So like corporate salaries, audit and legal fees, bad debt, the accountant's salary, right? the chief executive officer's salary. Those things wouldn't be in manufacturing overhead, right? This is really the indirect costs of a factory. So when you think about it in your mind, it's kind of like a funnel, right? You throw in direct material, you throw in direct labor, your indirect costs get put into manufacturing overhead, and at the end of the day, you come up with a unit of production. So every cost in your funnel should be involved in creating a unit of production, whether directly or indirectly. And the majority of the semester, what we'll be doing is looking at how to calculate and allocate those costs. It's exciting, isn't it? It's not bad. I like cost accounting. It makes a lot of sense. If you're good at it, you can go to a company and really save them some money. So it is exciting. This first little bit, maybe not so much. So that's manufacturing costs. Let's move from there into product versus period costs. This is sort of an extension on the same thing. Product costs are those manufacturing costs. Direct materials, direct labor, manufacturing overhead. Costs that are involved in producing a product, a unit of production, a cost object. These costs get recorded into inventory, so work in process or finished goods. So if you're building mailbox posts, the end of the year comes, there are 40 mailbox posts on the line. They're sitting in work in process. You've completed 100 mailbox posts. Those are sitting in finished goods. Both of those are inventory accounts on the balance sheet. They don't become an expense until the goods are sold. And if you remember from financial accounting, when you sell something, what is that? It's cost of goods sold. So that's product cost. Period cost is anything that's not a manufacturing cost, and they get charged to expenses incurred. And this is all of those selling and administrative expenses. It's CEO salary, it's insurance, it's rent, it's office building depreciation. All of those things become period costs. So product costs are directly involved with producing the product. Period costs are pretty much everything else. So if we look at an example, just to try and make it a little clearer, when we look at these different types of manufacturing costs and we look at period costs, here's an example that we just cooked up with a bicycle company, right? And every cost has to go somewhere. So here's an example of where some costs would go. So if you look at direct materials, this makes sense, right? Tires, spokes, handlebars, these things are physically part of a bicycle. Makes sense. They're things that cost enough that it's economically feasible to track them. Makes sense. Direct labor, employees who put tires on the bicycle wheels. You can't sell a bike without tires. You can, you shouldn't, right? So those tires getting on those bicycle wheels is very important to having the product. So the salaries of those employees are direct labor because they are directly related to the product. Then we look at manufacturing overhead. When you sell a bike, or when you buy a bike, you'll notice the chain on the bike is lightly greased, right? So chain grease is something that's in the factory. Every chain is greased when it leaves the factory, but it probably doesn't make a lot of sense to try and calculate the cost of greasing every chain on every bike in your factory, right? So that's something that would become manufacturing overhead. You buy a big, I don't know what grease comes in. You buy a big tub of grease, barrel of grease, I don't know. You buy a big barrel of grease, you use a little bit of it on every bike. You could just allocate that through manufacturing overhead. Factory depreciation is another thing. Office building depreciation would show up as a period cost, right? That office building doesn't directly impact the product. You need the factory to make the product, otherwise, how would you make the product? So factory depreciation isn't tied to a specific product, but you have to have it to make the product. So factory depreciation gets allocated over products. Factory manager salary, this could be the foreman or the safety inspector or things like that. That job needs to exist to make the product, but you can't tie it directly to a specific product. Same with factory maintenance employees. But all of these, direct material, direct labor, manufacturing overhead, they're all examples of a product cost. Period cost, on the other hand, are things like advertising expense, accountant salary, CEO salary, office building depreciation, insurance on the automobile fleet, right? It can be any number of things in period cost. So you see here the product costs are directly tied to a specific product or set of products. Period costs are not. Hopefully that makes it a little clearer. This is another area we'll spend a lot of focus through the rest of the semester. Cost is important. Defining cost is important because eventually we work our way to cost of goods manufactured, right? Under a periodic inventory system, the income statement of a merchandiser and a manufacturer are going to look different in cost of goods sold. This is probably not a revelation to you, right? If you look on the top of this chart, the merchandiser has beginning inventory, cost of goods purchased, less ending inventory is their cost of goods sold, right? Well, manufacturer, you're not purchasing goods, you're making goods. So it's beginning finished goods inventory, which is the inventory you could sell. Those things are done, they're good, they're ready to go. You add the cost of goods manufactured. You take away ending finished goods inventory. So beginning plus cost of goods manufactured minus ending is your cost of goods sold. And I think that makes sense. If we look here, for example, on the left, we see a merchandising company. You have inventory, you have cost of goods purchased. The total $720,000. Those goods are available for sale. At the end of the year, there's $400,000 in inventory. Therefore, you must have sold $320,000 of product. If you jump over to the right, you have a manufacturing company. So again, you have $90,000 in finished goods. Those are goods that are available to sell. You have $370,000 in cost of goods manufactured. And so you have $460,000 of goods available to sell. At the end of the year, there's $80,000 in finished goods inventory. So 460 minus 80, obviously you have $380,000 cost of goods sold. Pretty straightforward, really. Here's an overview of the formula. It's beginning work in process plus total manufacturing costs is the total cost of work in process. And this total manufacturing costs are all your direct material, all your direct labor, and all your manufacturing overhead for the current year. So that's your total cost of work in process. You move that down, and then you subtract your ending work in process inventory, right? Your ending work in process inventory are things that aren't done, things that aren't ready. So total cost of work in process minus ending work in process is your cost of goods manufactured. And here's an example of how you would calculate this. So on the left is the formula we just took a look at, and then on the right is a sample balance sheet. Sample income statement, rather. Thank you. So if you look at this, and we'll just start at the top. Work in process, January 1st, $18,400. So on January 1st, there was $18,400 of goods in your work in process inventory. And again, this is just things you're still working on, right? And then from there, we calculate our total manufacturing costs, direct materials, direct labor, manufacturing overhead. And we end up with $376,800 in manufacturing costs. So we take our work in process at January 1, $18,400. We add our total manufacturing costs of $376,800. So our total cost of work in process for the year is $395,200. At the end of the year, in work in process inventory, we have $25,200 worth of work in process inventory. Therefore, the cost of goods manufactured was $370,000. Spend some time with the formula. I think it makes sense. Let me know if you have any questions. So that's the income statement side of things, cost of goods sold or cost of goods manufactured. And then on the balance sheet side, manufacturers are a little bit different than merchandising companies. Merchandising companies, you just have inventory. You might create some subcategories internally, but at the end of the day, you just have inventory. Whereas a balance sheet for a manufacturer is always going to show three categories. You're going to have raw material inventory, work in process inventory, and finished goods inventory. Raw materials are things that you buy to make things, right? They're wood, they're sand, they're paper, they're, steel, cable, whatever you're using to build your product. Raw materials are just things that you will use to build your product. Work in process inventory are units that have been started but aren't finished, right? So if you look at the picture here, you'll see on raw materials, it's all the stuff you need to build a boat. I guess. Seems like you need more to build a boat. I don't know. I've never built a boat. Work in process, you see there's the start of a boat but is not done. And then finished goods inventory is the third inventory, and it shows the cost of completed goods on hand. Finished goods inventory is about like merchandise inventory for a merchandising company, right? Finished goods inventory is stuff that's ready to go and you're ready to sell. And then here's just a quick example. You'll see on the left some merchandising company. You have inventory. On the right is a manufacturing company. You'll have inventory with finished goods, work in process, raw materials. So your inventory is just a little more detailed. So income statement, what you need to worry about is cost of goods manufactured. Balance sheet, what you need to worry about is inventory. There's product versus period costs. And then knowing what your manufacturing costs are, direct labor, direct materials, manufacturing overhead. That really forms the basis of cost accounting, and what we do the rest of the semester is figure out how to calculate those things. So, real briefly, trends in managerial accounting. This is out of your book largely. Some of this I agree with. Product costing for service industries is a real trend in cost accounting. It's not going anywhere. As we go into, 2019, most of the U.S. economy has shifted towards services and away from goods, right? It's the knowledge economy. Over 50% of U.S. workers are now employed by service companies. A lot of what we do in cost accounting you can apply to a service company. Cost accounting was largely developed for manufacturers, but there's a lot of overlap, and you can use a lot of what we're going to talk about with service companies. That said, your book has a slant toward manufacturing companies, so I'll try to address it here and there. This is a really interesting case study. I tend not to pull the case studies out of the book, but I really like this one, which talks about Allegiant Airlines, and this is a few years old. This is 2009, 2010-ish. But back in the last recession, or the recession of 09-10, Allegiant increased its airline capacity by 21%. All the other airlines were losing money, reducing capacity, etc., etc., and Allegiant increased their capacity by 21%. So, why did they do that? And another question that the case study points out is Allegiant often has the industry's highest profit margins, but its average one-way fare is only $83. How does it do that? And the case study really just says, hey, as a low-budget airline, Allegiant focuses on controlling its costs. It purchases used planes. It says here $3 million instead of $40 million. It flies out of small towns, so they can pay people less. There's less competition. They minimize hotel costs. They have their flight crews go home at night when they can instead of keeping them in airports. And if a route is less than 90% full very long, Allegiant's going to drop it. And so the point of the case study is not that revolutionary, right? It's that Allegiant knows its costs to the penny. And by knowing its costs and by being able to track its costs and allocate its costs, it's able to get a higher profit margin. It's able to offer lower fares. It's able to control its costs. So if you remember from financial accounting last semester, one of the best ways to control your costs, one of the best ways to increase your revenue is to control your costs. So that's why cost accounting and managerial accounting is really important. And Allegiant is a great example of taking these techniques and applying them over to the service company side of the house. Another thing that really has caught a lot of traction the past few years and doesn't seem to be going anywhere is this focus on the value chain. So it really takes away the focus. Cost accounting really has historically been focused with that production component, right? Manufacturing itself. And as in the illustration here, it's really looking at the larger value chain, all the way from research and development, acquiring the raw materials, production, which is historically where we've been, all the way to sales and marketing, delivery, customer relations. So starting to take these managerial accounting techniques and apply them across the value chain, not just to production. Some more specific things, your book says that just-in-time inventory methods are a trend. They were a trend about 15 years ago. Now most companies just do this, right? It's an inventory system in which goods are manufactured or purchased just in time for sale. Toyota really started a lot of this. If you go to the Toyota Camry plant, which is in Georgetown, Kentucky, where I'm from Kentucky, not Georgetown, Eastern Kentucky, middle of nowhere. But if you go there, you'll see they keep about a week of inventory. They just order their inventory in time. Therefore, they don't pay inventory storage costs. They don't let things build up. They're able to keep their operation flowing more smoothly. An extension of that's total quality management, TQM. You'll still hear this talked about quite a bit, which is just reducing defects in finished products, right? It's looking at the complete value chain and looking at every step along the way, where could defects be introduced? And then it's trying to manage that chain to get it down to 0 defects. For example, maybe dumb example, but you're building a car and, every axle is 3 degrees out of alignment. Well, maybe you need to look at your supplier of raw materials, and maybe you're purchasing a bad piece of raw material, right? It's not necessarily something you're doing in your production process. You need to look at the entire value chain. If you're able to change that supplier at a comparable cost, you could reduce your defects. So you're looking at total quality management. An extension of total quality management, which isn't in your book, but I think is important, is Six Sigma. Six Sigma has been around for a long time now. It was started back in the 80s. It really gained a lot of traction in the early 90s at GE when Jack Welch was the CEO. And it's a disciplined, data-driven approach and methodology for eliminating defects. And what it's looking at is you drive towards 6 standard deviations. Sigma is a standard deviation. So you're driving towards 6 standard deviations between the mean and the nearest specification limit. So, if you think about the bell curve, right? The mean is in the center. And maybe you can go 3 standard deviations either direction, right? And as long as you're within those 3 standard deviations, you're okay. You're going to have minimal defects. So Six Sigma is really an extension of total quality management. A couple more things on the value chain. There's the theory of constraints, which is the theory that bottlenecks limit your company's potential profitability. So, a constraint could be physical. It could be an assembly line. It could be not enough employees. But not necessarily physical. A constraint could be a knowledge limitation. Maybe your company doesn't know how to do things. Maybe you don't have the appropriately trained employees to do things. And so the theory of constraints says you need to identify and manage these constraints to help achieve your company goals. And then activity-based costing, we'll talk more about later in the semester. I like activity-based costing. You'll hear it called ABC sometimes. And what it does is it allocates overhead based on the use of activities. So when we start out talking about manufacturing costs, you're going to see we'll talk about manufacturing overhead, right? And we'll allocate it fairly evenly across the products. That's not necessarily indicative of the real world, right? And so what activity-based costing tries to do is assign costs to the activities that are the real cause of overhead. Maybe you're making... I need to sit down and come up with my examples. Those of you who had me for 1010, I'm terrible with examples, and I don't seem to have gotten better. But maybe you're making a really simple, really easy screwdriver, right? And then you have another plant that's making brushless, cordless 20-volt drills with lithium-ion batteries, right? If you just allocate your overhead across products, you're probably not doing it. It's probably not indicative of the costs that you're really experiencing. So what activity-based costing tries to do is say, okay, there's probably more research and development activity with the brushless drill. There's probably more manufacturing hours involved with the brushless drill. There's probably more specialized parts involved with the brushless drill. So activity-based costing assigns costs to the activities that are the real cause of the overhead, and then it assigns the cost of those activities only to the products that demand the activities. Not a lot of research and development, I don't think. in building a screwdriver, but still a lot of research and development in building a better cordless drill, right? So you would, in activity-based costing, want to allocate more cost to the cordless drill. And the goal of activity-based costing is to cost your products more accurately, and to better understand the cost of all the activities in the value chain, which lets you, again, focus on managing your costs. The last thing that your book identifies as a trend, well, your book also mentions enterprise resource planning as a trend, ERP. ERP software are things like SAP, Oracle, Hyperion, JD Edwards. They're big software packages that help you manage your business. I don't think they're a trend. I think they're here. So I'm not going to talk about them. But your book mentions balanced scorecard. This has been around for a while too, but you'll still hear the term bandied about. And what a balanced scorecard does is it tries to evaluate your operations, and it tries to do that in an integrated fashion. So you don't just have financial statements sitting here, managerial accounting reports sitting here, HR reports sitting here, sales reports over here, right? A balanced scorecard tries to take a look at all the different corners of your organization and link that data together to help understand operations, help understand performance, and then understand how that picture, the picture that's on your balanced scorecard, help understand how that relates to the objectives of your company. So we'll talk more about balanced scorecards at the end of the semester. Excuse me. And then just real quickly, ethics. Ethics kind of pervades all of accounting. Ethics exists in managerial accounting as well. And that's mainly because systems and controls sometimes create incentives for managers to take unethical actions. And so the important note on this slide is that controls need to be effective and realistic, right? If you have production targets, if you have production thresholds, they need to be realistic. They don't need to be so high that they're going to encourage people to take a shortcut to achieve them. Conversely, they don't need to be so low that they encourage people to slack off, right? So you need to think about your controls in the context of an ethical situation and what they might be incentivizing unintentionally. And then if you had me in 1010, and I assume the other 1010s, Sarbanes-Oxley, we talked quite a bit about the Sarbanes-Oxley Act, which came around in 2002. It prescribes a set of internal controls. It prescribes a set of reporting requirements for publicly traded companies. And as it relates to managerial and cost accounting, it requires an internal controls report. So when you're doing managerial and cost accounting, a lot of times you'll be working with internal control systems or helping to improve internal control systems. So what I want you to remember about the Sarbanes-Oxley Act is that it increased penalties for financial misconduct or ethical misconduct. And then SOX 404, Sarbanes-Oxley Act Section 404, requires publicly traded companies to have a report on the effectiveness of internal controls in their financial statements. So ethics are just something to be aware of, obviously, as you go throughout any business situation, but particularly in accounting, right? There's a lot of explicit and implicit incentives sometimes to do the wrong thing. And a lot of times systems and controls can be developed to unintentionally encourage people to do the wrong thing. So that's a good introduction to, I think that's a good introduction to managerial accounting. Think about manufacturing costs. Think about product versus period costs. Think about cost of goods manufactured and inventory. And I will look forward to talking with you again next week. In the meantime, if you have any questions or concerns, don't forget you can always reach me on the email or call and text me. My information is there, and I will post the quiz, which you need to have done before midnight on Sunday the 27th. Have a good week.